welcome to CEO.CA's Mel on the Street. I'm your host, Mel, and today we're talking to Jay Hatfield, the CEO and Portfolio Manager of Infrastructure Capital Advisors. How are you doing today, Jay?
I'm doing great. Thanks for having me on, Melanie.
So I was thinking let's start with the big picture, your outlook for the stock market and the economy, and then narrow in on Infracap's ETFs and the investment strategy. First, can you talk a bit about your background and what you've learned about investing, particularly what's contributed to your success as an investor and the CEO of Infracap?
Well, I've been on Wall Street for 35 years. I was a CPA before I got my MBA from Wharton. And I think the thing that gives us an advantage, at least in this market, is I spent a lot of time on macro. When I was at Wharton, I was an undergrad economics major. And so you'll hear us, if you register for our webinars or information we send out, you're going to hear a lot about macro. And I do think that that's critical to investing. You have to get the macro right. You can't just have one stock idea, because it can be a great stock idea, but just not be working because of what's going on in the market and the economy. So I think that's our critical edge, is focusing on economics and doing good basic research on the market.
Yeah, and definitely management is so important, and investors need to be really looking at the management of any company that they're investing in. So Infracap just released its Market Economic Outlook report. Jay, I know you'll be walking investors through what you see for the stock market and the economy on July 17th during the upcoming webinar. But can you give us a preview of what you see for the upcoming months, particularly in terms of the Federal Reserve, global central banks, and the stock market as a whole?
Absolutely. We've been way more bullish than any Wall Street strategist. We started the year out with the 5,500 target on the S&P, which of course we're already at. And everybody else is way below that, or the rest of sell-side investment banks. Not that many buy-side publish a target. And then we raised that to 5,750 about 3 months ago, and we recently raised it to 6,000. And the reason for that is twofold. One is incredibly obvious, but the AI boom. But the less obvious one is the reason, what you already referenced, which is we've been optimistic that global central banks would cut rates. Most U.S. investors are too U.S. focused when it comes to economics. It's okay to just focus on U.S. stocks because they're usually the leaders in the world. But bonds are fungible, so you have to look at overseas economies. So we publish a global monetary base, and we believe the ECB's already started cutting about 5 other major countries. So this global liquidity, we think, is going to continue to power stock and bond markets higher, and rates lower, of course, and will feed this rally and get us up to that 6,000 target, particularly with a likely broadening. If we're going to get to 6,000, we need a broadening of the market, not just the same 10 stocks, say, rallying every day to potentially unsustainable valuations.
So while you're bullish on AI and the stock market in general, in the report, you're slightly, if not very bearish on the EV sector. Although EV makers such as Tesla and Lucid have rallied recently after reporting second quarter delivery and production numbers that came in well above estimates. In your report, you state the utopian vision of an all-electric economy has now completely imploded. What does that mean, do you think, for the future of EVs and renewables, and what's your outlook on the commodity market?
Well, first I would just say that I'm definitely an environmentalist. I was the first environmental investment banker ever, which that and $5 gets you a cup of coffee at Starbucks. But I've always been an environmentalist. And so I've been concerned about the trends in the environmental sector because people are not very practical about what can really be done. So the most practical solution are hybrids. So we prefer Toyota Motor, so we don't hate all electrics or hybrids, over Tesla. Now, having said that, Tesla is a momentum stock. I think Bill Gross, said even today recently that it's a meme stock. It's turned into a meme stock. So I'm not saying that you shouldn't gamble on Tesla and see what it can go to. But the hybrids are the near-term path, and in the long-term, yes, we'll have the electrics, but we're derailing ourselves and missing out on opportunities to incentivize hybrids, not just all electrics. And then we're also missing the opportunity to immediately close all coal plants in the world and substitute in natural gas. So in Europe, they actively discourage natural gas as well, and now they're burning more coal. So, Mike, I'm not anti-environmentalist. I just think that we should price carbon and then pursue the optimal solution. And by the way, price other pollutants, because coal is an abomination, not just on carbon, but a whole bunch of other pollutants, mercury being the worst, of course. And so we should tax those or price those emissions. Coal will shut down. Everybody will be way healthier. It's way more economic. It'll happen faster. It's better for the environment. So I'm just in favor of an optimal solution, not one entrepreneur's vision that we're going to drive all electric cars in the next couple of years.
So if we move now to dive more deeply into Infracap's funds, can you walk me through the focus of the firm and give me an overview of the ETFs that you offer?
Yeah, so we believe that all investors should be income focused. Even if you're young and not going to retire for 50 years, you should still know the income of your portfolio. It might be 1 or 2%, but you should still know what it is. I took over a separate account of a friend from high school, and I said, well, what's your yield? He said, well, what's that? Because he didn't really, the advisor fees were chewing up all of his yield. They didn't have a lot of yield investments. So we're focused on funds that produce high levels of income that make investors, particularly older investors, more comfortable because they can look at their income and say, oh, well, X% of my expenses are covered by income. So then I'm comfortable regardless of what happens to be happening in the market today or last year or next year. And so most of our clients like that comfort. We recommend it as part of a strategy, at least for people looking at retirement or building towards retirement. Like I said, you could be 20 and still have income. My kids have income in their portfolio. So we think that that's something people should focus on, and also keeps you out of meme stocks and gambling, which is not appropriate if you're more long-term focused.
Sure, and provides diversity, of
Right.
course.
Absolutely.
Focusing on the Infracap Small Cap Equity ETF, which is ticker SCAP, a lot of investors, particularly retail investors, are interested in small cap stocks because they have lower price points, allowing them to buy a greater number of shares of multiple securities in order to have to diversify their portfolios. Can you talk about SCAP and the advantages investors have by choosing to invest in that ETF in particular?
Yeah, so we do focus on income there. We do include some preferred stocks. So it does have a pretty attractive yield over 6%. So that's hard to get with a lot of just pure small cap stocks. And then the most important thing about small caps is that it's critical. As I said, I don't believe in gambling when you're investing. It's fine to gamble when you're gambling, but not when you're investing. Mm-hmm. So if you look at the Russell 2000, which is the broadest index, about 20% of those companies are losing money. And I don't think it's appropriate for those companies even really to be public, but certainly not for individual investors to be buying money-losing companies. It's generally not a good idea. So we don't have any money-losing companies. And we also we're basically GARP investors. So we look for growth at a reasonable price. So we don't want to pay 50 times earnings for something growing at 10%. We might pay 20 times earnings. And we want substantial dividends. So it's a lot of work to go research small caps. One of the companies that we are invested in is Coke, C-O-K-E. It's a bottler, not K-O. Yep. And there is absolutely zero sell-side research outstanding. So you can't just, even if you're a Merrill Lynch customer or some other customer of a big brokerage house, you can't just say, well, send me the research report for C-O-K-E. So it can be harder to research those companies for individual investors. So we always recommend maybe buy some of our funds, but if you want to buy some of the companies we own or some other companies you like, fine. But it's hard for an individual to go research, say, 50 to 70 companies like we have, do that, a good job of that. So it's a good way to get to some diversification and not having to do all that research on your own, particularly when there's very thin sell side research.
Absolutely. So just to carry on from that point and to close things out, what advice do you have for investors in terms of risk versus reward and diversification?
Well, I'd say first that without risk, should be no return. The two key risks are stock market risk and interest rate risk. So we have a fixed income fund, PFFA, that has more interest rate risk, less stock market risk. Small caps tend to be a little bit riskier than the market, but they have outperformed the market in the long run. So I would just always know what the risks are and the returns. And if somebody said there's no risks, then there's a lot of return, then you need to do more research.
Absolutely. Well, thank you so much for joining us today. It's been great talking to you.
Great. Thanks, Melanie. It's great to be on.